Are you someone who has an RMD tax problem? Meaning that the government is forcing you to take money from your tax deferred accounts, money you may or may not need. And that forced income is forcing you into some negative tax consequences. Or maybe you're someone who is not yet at the age that they need to take required minimum distributions, but because of your large tax deferred balances, you estimate that you will have one of these RMD problems. Well, there are a lot of different things that you can do in order to minimize RMDs, but an often overlooked strategy, specifically for those that want to give to charity, is using charitable giving strategies to minimize RMDs. Now, there are a lot of different ways that you can use charitable giving strategies within your retirement. In today's video, we're going to be talking about a very specific strategy called a QCD, or otherwise known as a qualified charitable distribution. And we're going to show how you can use QCDs in your retirement in order to minimize RMDs and effectively take a pass on the tax liability that comes from that given RMD. Now, make sure you watch until the end of this video because we're going to be covering a lot of details around using a QCD, different strategies you can use with that QCD, and covering some important information that you're certainly going to want to know about. If you watch this video till the end and you end up liking this video, please leave a like down below. It'll help other retirees just like yourself find this video. So let's get into it. As we talk through one of these RMD tax problems, what exactly are we talking about? Well, for a lot of our clients, they're in a fantastic situation where they don't want to take that RMD. Okay, meaning that they've set their situation up well enough, they have a reasonable retirement goal income, and that RMD is really excess income that's forced by the government that they may or may not need in a given year. And here's a classic situation that we see on a regular basis. This couple has a $35,000 RMD that's up and above their income need. Now, that RMD in and of itself doesn't look like that bad of a tax consequence because that RMD is going to force them partially taxed at the 12% bracket, partially taxed at the 22% bracket. So the total tax that they're going to owe for federal income taxes on specifically that RMD is $6,275. But that RMD is also going to force a portion of their Social Security benefits into being taxed as well. Because again, their taxable income outside of Social Security forces Social Security to be more taxable. And so the additional taxes that they're going to owe on Social Security is also going to be $5,333. And then they're also going to have some state tax, given the state that they reside in, on that RMD as well, which is going to be $2,012. And so their total additional tax on this given RMD is $13,620. Now, put in tax terms, their marginal tax rate on this given RMD is 38.9%. So they're taking $35,000 from their accounts, but as we can see, they're really only retaining a portion of that given RMD. Their after-tax retained RMD is $21,380. And so they're asking themselves, is there a better way that we can get more out of this money? Meaning that we can either keep more of these RMD dollars or we can pass this RMD to a cause that we care about and have that cause that we care about receive the large portion of their RMD. Because as they see from their situation, they're only receiving a fraction of the benefit of this RMD if they retain that RMD themselves. And there is a way that they can essentially pass on this RMD in a more tax efficient way by using a QCD. Now, we're going to touch on that in a second. But when are RMDs most destructive? When do we see RMDs most destructive in given tax situations? Well, there are a lot of different tax hurdles that an RMD can push you into. One of those would be a Medicare increase, IRMA. But one that we often see is the Social Security tax torpedo. Now, we're not going to cover this completely in depth. We have numerous videos that I'll link to in the upper right hand corner talking through what the Social Security tax torpedo is. But where these RMDs can be especially destructive for retirees is when we see them in a tax situation like the one we're going to talk through right here. Let's say that they have about this much money coming from their various other income taxable sources before their RMD. So this shows something like $50,000 in income coming from their other taxable sources. That might be a pension, that might be rental income, that might be other things, okay? And this RMD is an excess. This is money that they don't necessarily need. So given that they weren't required to take a required minimum distribution, they would forgo taking any money from their tax deferred accounts. But this given RMD is pushing them into higher marginal brackets. And really how this is created, again, the Social Security tax torpedo. As you take income from other taxable sources, it forces more of your Social Security benefit into being taxed. Now, we're looking at 2026 estimates. So this is after the Tax Cuts and Jobs Act. And basically what we're going to see here is even though intuitively they think they're in the 15% bracket and 25% bracket, this RMD is actually pushing more of their Social Security benefit into being taxed. So they're actually taxed at a marginal rate of 27.75% and then 46.25%. Now this is just looking at federal income taxes. So when you take out and add in state taxes as well, this tax situation looks that much worse. And so RMDs can be especially destructive during these exact situations. And so what can we do with this RMD to get more value out of that forced required minimum distribution? Well, what are your retirement goals at the end of the day? Now, a big overarching tax planning goal in general is we want to keep the maximum amount of your dollars, your wealth, going towards your goals. So that can show up differently in everyone's situation. That might mean giving to charity. Maybe that might mean that you want to retain all of your dollars and simply take the maximum income that you can take in any given year. Maybe you want to retain some of those dollars to pass on to the next generation. Everyone has different goals. But for those that want to give to charity, there are a lot of other strategies that you can use. Now, benefiting from charitable giving in recent years has become more complicated. The reason being is the Tax Cuts and Jobs Act raised the standard deduction for a married couple by about $10,000. And so right now in 2021, the standard deduction is $25,100 for a married couple. It might be higher if you are over 65 and you get the over 65 standard deduction add-on. But essentially giving to charity has become more difficult because in order to give to charity and receive a tax benefit from it, you essentially have to itemize deductions. Now let's say that you're planning on itemizing deductions and you give in $5,000 to charity this year, and outside of those itemized deductions, you might have things like state and local taxes, SALT deductions. Well, that has a maximum of $10,000 that you can take as a deduction. Let's say you have a few other itemized deductions, but in total, you're only able to itemize $17,000 worth of deductions. Well, you aren't getting any benefit at that point from that given charitable contribution because that charitable contribution is within your itemized deductions and your itemized deductions are less than the standard deduction that you could take. So you'd be better off taking that standard deduction. And so that $5,000 charitable distribution, or charitable giving, I should say, doesn't benefit you at all, okay, from a tax standpoint. Okay, so charitable giving has become more difficult in recent years. But if you have the goal of giving to charity in retirement, I urge a lot of my clients to give while they're still alive. Don't only leave your charitable giving until you pass away and whatever's left you'll split partially between your heirs and partial to charity. Give while you're still alive. For a couple different reasons. One, you gain a tax benefit from doing so. And number two, you get to see the benefit of your charitable giving. Now, let's get into talking about this QCD strategy. What is a QCD? Well, it's a qualified charitable distribution. Now, this is so important and so valuable because it's an above the line deduction, meaning that you don't need to itemize. If you give a $5,000 charitable contribution from a QCD, that immediately leaves your taxable income. You aren't required to itemize in order to gain that given tax benefit. Okay, you must be 70 and a half or older. This was a recent rule that was put into place before the RMD age was changed until 72, but this QCD age stays the same at 70 and a half. Okay, the max amount that you can give in a QCD is $100,000 per person. So a couple can give up to $200,000 in the form of this QCD strategy. It must go directly to a qualified charity, a 501(c)(3) organization. You can't take this as a distribution and then write a check to that given charity. It will no longer count as a QCD if you do that. And now that I'm seeing on the screen here, I have must go to a qualified charity twice on the screen. So ignore that second one here. But there's an important thing to remember, and that's the RMD aggregation rule. So again, basically what a QCD is going to do is it's going to eliminate the RMD that you must take. So let's say that you have a $50,000 RMD, or actually let's go back to that $35,000 example. Rather than them retaining that RMD and retaining, a fraction of the RMD that they could retain because of the tax consequences it would have, they can send that full $35,000 to a charity. And so rather than the IRS getting a cut of that RMD, now it goes to the full benefit of whatever charity, whatever cause they ultimately choose. And it's eliminated from their taxable income in that given year. So essentially, they're retaining more of their money towards their giving goals, which again, we talked about is the overarching goal of tax planning. Now, there's an important detail that you need to remember when trying to eliminate RMDs through QCDs, and that's the RMD aggregation rule. So let's say that you have accounts at various places, different tax deferred accounts. In this person's given situation, John has a 401k that they have a $37,400 RMD from. They have a few IRAs with their current advisor. They'll have $21,000 of RMDs from that. And then Beth has a 403b that she's going to have a $16,800 RMD. And so their total RMDs are going to be $75,200. Okay, now the aggregation rule specifies that given these different tax deferred accounts, you have to separately take RMDs from each of these accounts. Again, I'll link in the upper right-hand corner to that given aggregation rule video that we've previously recorded. And so now when you're thinking about using a QCD to eliminate these RMDs, you can't just take $75,200 from one given account and satisfy your RMD requirement by, again, using this QCD strategy. You have to take from each account equally. Take a QCD from each account equally in order to satisfy this RMD aggregation rule. So that's extremely important to know as you're using QCDs. Now, I typically recommend that most clients, for simplicity, try to roll all of their tax deferred accounts into IRAs for that given person to sidestep a lot of these aggregation rules. Now, how can we start to use QCDs in a forward-looking tax plan? Again, for those that are new to our channel, basically what a forward-looking tax plan is, rather than just planning each and every year for your given tax situation, taking a shoebox full of receipts into your CPA and saying, what can you save me? In retirement, you want to have a forward-looking tax plan that estimates future tax liabilities, because in a lot of cases, you need to be dealing with given problems like RMDs earlier in retirement. You can't procrastinate and wait because a lot of your options will be eliminated. And so this is a classic forward-looking tax graph that we develop for our clients. And as you can see, given this person's situation, early in retirement, they're in much better tax situations than they are later in retirement when RMDs start. And so Roth conversions can be a fantastic way to minimize RMDs. But for those that have a charitable giving interest, I would urge you to also use QCDs as part of your forward-looking tax plan. It will allow you to convert less, thus paying less in taxes to the IRS. And again, using these QCDs throughout your retirement to eliminate a lot of that RMD tax burden that we're trying to avoid. That's pushing us up into these higher brackets here. And so rather than trying to completely eliminate these RMDs or eliminate the majority of these RMDs, they might be able to do less in Roth conversions early in retirement and instead give the top end of those RMDs in the form of a QCD, thus eliminating them from their taxable income. And again, eliminating the tax altogether, having that money go to the charity, the cause that they most care about. Another strategy that we've used effectively with retirees is, let's say that you have an RMD that doesn't necessarily put you into some really negative tax consequences. Let's say that because of pension income, you're already past that Social Security tax torpedo, meaning your Social Security benefit is fully taxable. And now we're simply looking at a situation where that RMD is back to those normal tax tables that we discussed. And so again, a strategy that I've seen used effectively as well with our clients is, rather than, let's say they have a $45,000 RMD. If the goal is to minimize tax deferred balances going forward into the future to try to eliminate future RMDs, what this retiree can do is they can take the $45,000 RMD that they are set to take that in the form of a QCD, sending that right to a charity. And so again, it'll basically be like they never took that RMD in the first place. They won't have any tax consequences from that given RMD. But instead, fill in that taxable income that they would have had from that RMD, fill that in with a Roth conversion. Now, why might a retiree want to do this? Okay, they're essentially lowering their tax deferred accounts, thus minimizing RMDs moving forward in the future. So rather than $35,000 or $45,000 leaving their tax situation if they would have just taken that given RMD, now they are able to essentially take that $45,000 in the form of a QCD from their situation and perform another $45,000 Roth conversion, thus lowering their future tax deferred balances by $90,000. So minimizing RMDs well into the future then. And so there are a lot of different ways that you can use these QCDs. I often tell my clients, specifically those that want to give to charity, we don't have to convert as much as we move through time if we're willing to give to charity while we're still alive. Now, there are a lot of different things that you'll want to discuss with your given financial advisor, your retirement planner. For instance, how much do we actually want to give? Again, you might not want to give all of your RMDs, and so then, again, your forward-looking tax plan will need to change. You may need to do some conversions using some of those QCDs. But again, giving to charity while you're still alive, you can gain that tax benefit, and you can also gain the satisfaction of giving to the causes that you most care about. Hopefully this video was informational and showed some different strategies that you can use in order to give to charity and minimize RMDs. Always remember, you don't need more money, you need a better plan. If you like this video, please leave a like down below. Also, hit the subscribe button. We release videos weekly on how you can improve your retirement and get more out of your retirement plan. Thanks for watching. Hope you have a great rest of the day. We will see you in the next video.